Imagine waking up one morning and discovering that the financial ground beneath your feet has shifted. Not dramatically, not with sirens blaring or headlines screaming, just quietly, subtly, like watching the tide go out before a storm. That is precisely what is happening right now in the global economy, and most people have absolutely no idea. China has just offloaded 8 of $47 billion worth of U.S. Treasury bonds. Japan followed suit. Two of the largest creditors to the United States government are walking away from American debt. Now, before your eyes glaze, overthinking this is just another boring economics lecture. Let me tell you something critical. This single event will ripple through your life in ways you cannot yet imagine. Your savings, your mortgage, your pension, the price you pay for groceries next month. Everything is connected. Most of us go through life believing that money is this permanent, stable thing. We trust it. We work for it. We save it in banks and assume it will hold its value, but money is not what you think it is. Money is actually a claim on future productivity. It is a promise. And right now, some of the biggest players in the world are quietly questioning whether that promise can be kept. Think about it like this. Imagine you lent your friends a significant amount of money. At first, your friend was reliable, paid you back on time. You trusted them completely, so you lent them more and more, until one day you notice they are borrowing from everyone. Their spending is out of control. They are printing IOUs faster than they can possibly repay them. What would you do? You would start pulling your money out, would you not? Slowly at first, then faster. That is exactly what China and Japan are doing with U.S. debt. Here is what you need to understand. For decades, countries like China and Japan accumulated trillions of dollars in U.S. Treasury bonds. Why? Because the United States was the safest bet on the planet. The dollar was king. American bonds were considered the ultimate safe haven. If you had excess cash, you bought U.S. debt. Simple as that. But something fundamental has changed. The United States has been running massive budget deficits for years. Trillions upon trillions in debt. The government keeps spending far more than it collects in taxes. And how does it cover the difference? By issuing more bonds, more debt, more promises to pay back money it does not currently have. Now, when you are the global reserve currency, you can get away with this for quite a while. The whole world needs dollars to trade oil, to conduct international business, to settle transactions, so there has always been demand for U.S. debt. But demand is not infinite, and trust, once broken, is incredibly difficult to rebuild. China looks at this situation and thinks strategically. They see an America that is politically divided. They see an economy propped up by endless money printing. They see interest rates that were kept artificially low for so long that the entire financial system became addicted to cheap debt. And they think to themselves, maybe it is time to diversify. Maybe it is time to reduce exposure to an asset that might not hold its value in the future. Japan faces a different but equally pressing problem. Their own economy has been struggling for decades. They have an aging population, massive debt of their own, and when interest rates started rising globally, holding low-yielding U.S. bonds suddenly became less attractive. They need that capital at home. They need liquidity. So they sell. This is not about conspiracy theories or dramatic collapse scenarios. This is about cold, rational economic decision-making. When the biggest creditors start reducing their holdings, it sends a signal. It tells the market that something has shifted in the risk calculation. Now here is where this affects you directly. When demand for U.S. debt decreases, the government has to offer higher interest rates to attract buyers. Higher interest rates mean higher borrowing costs across the entire economy. Your mortgage becomes more expensive. Business loans cost more. Credit cards charge higher rates. The whole machine slows down, but there is something even more important happening beneath the surface. We are witnessing a gradual but unmistakable shift in the global financial order. The dollar has been the dominant reserve currency since the end of World War II. That dominance gave America enormous economic and political power, the ability to run deficits that would cripple other nations, the ability to sanction countries by cutting them off from the dollar system, the ability to export inflation to the rest of the world. That era is not ending overnight, but it is changing. Countries are slowly, methodically building alternative systems, trading in their own currencies, stockpiling gold, creating new financial infrastructure that does not run through New York or London. The wealthy have understood something for centuries that most people never grasp. They do not just watch the news and react. They study patterns. They observe the tides of capital flows. They position themselves ahead of major shifts, not after. Right now, while everyone is distracted by daily market fluctuations and political theater, the truly informed are watching this debt sell-off and asking themselves one crucial question: what comes next? Let me share something with you that changed how I think about money forever. There are three types of people in any economy: those who understand the rules, those who follow the rules without understanding them, and those who are completely unaware that rules even exist. The first group builds generational wealth. The second group works their entire lives and hopes for a comfortable retirement. The third group struggles perpetually and wonders why financial success seems so elusive. Understanding what China and Japan are doing right now puts you in that first category, because this is not just about treasury bonds. This is about recognizing that the financial system is always evolving, always shifting, and those who see the changes early can protect themselves and even profit. Think about the average British household right now, when maybe they have some savings in the bank, earning almost nothing. Perhaps they own a home with a mortgage. They contribute to a pension fund they barely understand. They assume their currency will maintain its purchasing power. They trust that the system will continue functioning exactly as it has for their entire lives. But what if the fundamental assumptions underpinning that system are changing? History is filled with examples of currencies that seemed permanent until suddenly they were not. The British pound was once the global reserve currency. Then it was not. The Spanish real, the Dutch guilder, each dominant in their time, each eventually replaced, not because of sudden catastrophe, but because of gradual shifts in economic power, trade patterns, and most importantly, trust. Now, I am not saying the dollar will disappear tomorrow. That would be absurd. What I am saying is that its dominance is being questioned in ways it has not been questioned in generations. And when the reserve currency begins to lose its privileged position, the effects cascade through every asset class, every economy, every individual wallet. So what does this mean for you practically? It means diversification is not just smart, it is essential. Not just diversification of investments, but diversification of how you think about wealth itself. Your grandparents might have believed that working hard, saving money in the bank, and buying a house was enough. And for their generation, it often was. But the rules have changed. Inflation is the silent thief that robs you while you sleep. When governments run massive deficits and central banks print money to cover those deficits, the value of each unit of currency decreases. Your savings lose purchasing power. Your salary, even if it increases nominally, might buy less than it did the year before. This is not theoretical. This is happening right now. The wealthy protect themselves from this by holding assets that maintain value regardless of what happens to paper currency. Real estate in desirable locations, businesses that generate cash flow, Commodities like gold and silver that have been stores of value for thousands of years. Productive assets that create income streams independent of any single currency. But here is what most people miss. It is not enough to just buy assets randomly. You need to understand why you are buying them, what purpose they serve in your overall strategy, how they protect you against different types of economic scenarios. Let me give you a concrete example. Imagine two people, both earn £50,000 a year. Person A saves 10% in a bank account earning minimal interest. Person B also saves 10%, but splits it between learning new high-income skills, investing in dividend-paying stocks, and acquiring small amounts of physical gold. 10 years pass. Inflation averages 4% annually. Person A has accumulated £50,000 in the bank, but its purchasing power has eroded significantly. Person B has not only preserved wealth, but likely grown it substantially through skill development, leading to higher income, dividend reinvestment, and gold appreciation during inflationary periods. The difference is not intelligence. It is not luck. It is understanding how money actually works in the real world versus how we are told it works. China and Japan dumping U.S. debt is a symptom of a larger disease. The disease is unsustainable fiscal policy, governments spending far beyond their means, central banks manipulating interest rates and money supply to paper over structural problems. This creates bubbles, asset price inflation, wealth inequality, and eventually loss of confidence in the currency itself. You cannot control what governments or central banks do, but you can absolutely control how you respond. You can educate yourself. You can position your finances to weather multiple scenarios. You can build skills that create value regardless of economic conditions. You can develop a mindset that sees opportunity where others see only crisis. The truly powerful insight here is this. Every major shift in the global financial system creates winners and losers. Those who understand what is happening and why can position themselves as winners. Those who remain ignorant or complacent often end up on the wrong side of the equation. Right now, at this very moment, capital is flowing in new directions. Power is shifting. The financial landscape is being redrawn, and you have a choice. You can either be a passive observer, watching your financial future being shaped by forces you do not understand, or you can become an active participant who sees clearly and acts decisively. Let me tell you what the smartest investors are doing right now, while everyone else is paralyzed by confusion or denial. They are not panicking. They are not making rash decisions based on fear. They are calmly reassessing their entire financial framework based on new realities. They understand that when the largest creditors to the United States begin reducing their exposure, it signals something profound about the future of money itself. Here is a principle that has held true throughout all of human history. Wealth flows towards safety, productivity, and trust. When any of these three elements are compromised in one place, capital moves to where they exist more abundantly. China is not selling U.S. debt because they suddenly dislike America. They are selling because the risk-reward calculation has shifted. The trust has been diluted, and they are redirecting that capital toward things they believe will better serve their interests. Now, you might be thinking, what does this have to do with me and my everyday financial decisions? Everything. Absolutely everything. Because the same principles that govern how nations manage trillions apply equally to how you should manage your thousands or hundreds of thousands. Consider your own financial ecosystem. Are you concentrating all your trust, all your wealth, all your future security in a single system that might be changing in fundamental ways? Most people are. Their salary comes in pounds or dollars. Their savings sit in banks denominated in that same currency. Their pension funds are invested primarily in assets priced in that currency. Their entire financial existence is tied to the continued stability and strength of one monetary system. This is extraordinarily risky, not because collapse is imminent, but because concentration itself is always risky. The wealthiest families in the world do not keep all their eggs in one basket. They diversify across currencies, across asset classes, across jurisdictions, across time horizons. They build resilience into their financial structure. Think about it this way. A tree with deep roots and branches spreading in multiple directions can withstand storms that would topple a single rigid pole. Your financial life needs to be like that tree. Multiple income streams, multiple asset types, multiple strategies for different economic environments. This is not paranoia. This is wisdom. Japan's decision to reduce U.S. Treasury holdings while simultaneously increasing investments in infrastructure, technology, and regional development tells us something crucial. They are betting on productivity and tangible value creation rather than paper promises. They are moving capital from passive holdings into active, productive uses. There is a lesson in that for every single one of us. When you hold cash in a bank account, you are essentially holding a claim on future productivity. But that claim loses value over time if the underlying productivity does not keep pace with money creation. However, when you invest in developing skills, building businesses, acquiring productive assets, or gaining knowledge, you are directly increasing your ability to create value in the future. You are building actual capability, not just holding claims. The most successful people I have studied throughout history shared one common trait. They understood that true wealth is not about accumulating paper. It is about building systems that generate value regardless of what happens to any particular currency or government. A skill that solves problems for others, a business that serves real needs, property in locations where people will always want to live, investments in human innovation and productivity. Right now, we are living through a moment that future historians will write about. The gradual shift from a unipolar financial world dominated by one reserve currency to a multipolar world where power and wealth are more distributed. This transition will not happen overnight. It will unfold over years, perhaps decades. But the direction is becoming clearer with each passing month. What makes this particularly challenging for ordinary people is that the education system never taught us how to navigate these waters. We learned algebra and history and literature, but nobody explained how currencies work, why inflation happens, what central banks actually do, or how to protect wealth across different economic scenarios. We were taught to be employees and consumers, not financial strategists. But here is the beautiful truth. It is never too late to learn. Every single day, you have the opportunity to become more financially literate, more aware, more prepared. You can study how successful investors think. You can learn from historical patterns. You can develop the mental frameworks that allow you to see clearly when others are confused. The wealthy do not have secret information that is unavailable to you. They simply pay attention to different things. While most people watch entertainment and follow celebrity gossip, the wealthy study economic data, capital flows, policy changes, and geopolitical trends. They connect dots that others do not even know exist. When China sells $847 billion in U.S. debt, the wealthy ask themselves a series of questions. What does this tell us about Chinese economic strategy? What does it reveal about their concerns regarding U.S. fiscal policy? How will this affect interest rates globally? Which assets will benefit from this shift? Which will suffer? How should we reposition to take advantage? Meanwhile, the average person does not even hear about it. Or if they do, they shrug and change the channel. That difference in awareness That gap in understanding is precisely why wealth inequality continues to grow. Not because of some grand conspiracy, but because of vastly different levels of financial education and engagement. Let me share something that might make you uncomfortable but needs to be said. Your financial future is not the government's responsibility. It is not your employer's responsibility. It is not the responsibility of the pension system or the welfare state. It is yours and yours alone. The sooner you accept that reality, the sooner you can take control. Governments will do what serves their political interests. Central banks will do what they believe serves monetary stability, which often means protecting the financial system rather than individual savers. Employers will pay you the minimum necessary to keep you productive. Nobody is coming to save you. But the flip side of that harsh truth is incredibly liberating. You have the power to change your trajectory starting today. Every financial decision you make from this moment forward is either moving you toward freedom or keeping you trapped in a system designed to extract value from your labor while giving you just enough to keep you compliant. That sounds harsh, perhaps even cynical, but understanding this reality is the first step toward transcending it. Think about how the current system actually works. You trade your time and skills for currency. That currency loses value every single year through inflation. You are encouraged to spend most of what you earn on consumption. The small portion you manage to save earns interest rates that rarely keep pace with real inflation. Meanwhile, those who own productive assets, those who control businesses and property and intellectual capital, see their wealth compound year after year regardless of how hard they personally work. This is not an accident. This is how the system is structured, and complaining about it changes nothing. But understanding it, truly grasping how the machine operates, gives you the power to position yourself differently within it. When major creditor nations begin reducing their holdings of U.S. debt, they are essentially saying the same thing you should be thinking about your own financial positioning. Is this still the best use of capital? Are there better opportunities elsewhere? Am I too concentrated in one area? How do I preserve what I have worked for while also growing it? The answer lies in becoming what I call financially multi-layered. You need foundations, savings for emergencies, insurance against catastrophic events, but you also need growth engines, investments that compound over time, skills that increase your earning power, networks that open doors, knowledge that gives you advantages others lack, and you need hedges, protection against inflation, diversification across different types of assets, strategies that work in multiple economic scenarios. Most people build their financial lives like a single-story structure: one job, one income source, savings in one currency, everything dependent on a single economic system continuing to function exactly as it always has. But what happens when that system changes? When inflation erodes purchasing power faster than wages increase? When interest rates shift dramatically? When the rules of the game are rewritten? A multi-layered financial life is resilient. If one layer underperforms, others compensate. If one strategy fails, alternatives exist. This is precisely what China and Japan are doing at a national level, reducing dependence on any single asset or relationship, building alternatives, creating optionality. Let me give you something practical you can implement immediately. Start tracking where your money actually goes. Not vaguely, not approximately, precisely. Most people have no idea where their income disappears to each month. They earn, they spend, and somehow there is never quite enough left over. This lack of awareness is financial suicide. Once you know exactly where your money flows, you can make conscious choices rather than unconscious ones. You might discover you are spending hundreds of pounds monthly on subscriptions you barely use, on convenience purchases that add no real value to your life, on status symbols that impress nobody who matters. That money, redirected toward learning, investing, or building, could transform your financial future within years. The second practical step is to increase the gap between what you earn and what you spend, not through miserable deprivation, but through intelligent efficiency. The wealthy understand that every pound saved is actually worth far more than a pound earned, because saved pounds can be invested to generate returns. Earned pounds are taxed heavily before you ever see them. If you can create even a 10% gap between earnings and spending and invest that difference consistently into appreciating assets, you will be wealthier than 90% of the population within a decade or two. Not because of magic, not because of luck, because of mathematics and compound growth. Here is what compound growth actually means in real terms. If you invest £5,000 at age 25 and it grows at 8% annually, by age 65 it becomes over £100,000. But if you invest that same £5,000 and add just £200 monthly for those same 40 years, it becomes over £700,000. The difference between financial struggle and financial freedom often comes down to consistent small actions compounded over time. But most people never experience this because they are trapped in immediate gratification cycles. They earn money and immediately convert it into depreciating consumption. New cars that lose value the moment they are driven off the lot, clothes that go out of fashion within seasons, entertainment that provides momentary pleasure but builds nothing lasting. Meanwhile, the wealthy delay gratification. They invest first, consume later, and only from the surplus generated by their investments. This is not about living like a monk. This is about understanding that every financial choice has an opportunity cost. When you spend £1,000 on a holiday, you are not just spending that £1,000. You are giving up what that £1,000 could have grown into over 10 or 20 years if invested. Maybe £3,000, maybe $5,000, maybe more. Sometimes the holiday is absolutely worth it, but you should make that choice consciously, understanding the true cost. Now let us connect this back to what is happening globally. When China reduces its U.S. debt holdings, it is making exactly this type of calculated decision. They are saying the opportunity cost of holding low-yielding bonds in a potentially depreciating currency is too high compared to alternative uses of that capital. They are choosing growth and diversification over perceived safety that may be eroding. You need to apply this same logic to your own situation. Is keeping all your savings in a bank account really safe if inflation is running higher than the interest you earn? You are guaranteed to lose purchasing power. That is not safety. That is slow financial death. True safety comes from diversification, from owning assets that maintain value across different scenarios, from having skills that remain valuable regardless of economic conditions. The truly transformative insight is this: money is not the goal. Money is a tool. The goal is freedom, the ability to make choices based on what you want rather than what you must do to survive, the ability to help those you care about, the ability to pursue meaning and purpose without being enslaved to a paycheck, the ability to weather economic storms without panic or desperation. And that freedom is absolutely achievable for anyone willing to educate themselves, make intelligent choices consistently, and play the long game rather than seeking quick wins that rarely materialize. The difference between those who achieve financial freedom and those who remain trapped is not intelligence, background, or luck. It is mindset. It is the willingness to think differently than the crowd, to question assumptions everyone else accepts without examination, to see opportunities where others see only obstacles. Right now, while markets digest the implications of major creditor nations reducing U.S. debt exposure, most people are doing nothing. They are paralyzed by complexity, overwhelmed by information, uncertain about what actions to take. But uncertainty is not a reason for inaction. Uncertainty is the environment in which all wealth is built. Every great fortune in history was created during periods of transition and uncertainty, when old systems were breaking down and new ones emerging, when others were fearful and confused, when conventional wisdom was being proven wrong. The Industrial Revolution, the Information Age, the rise of global trade. Each transformation created enormous wealth for those who understood what was happening and positioned themselves accordingly. We are living through such a transformation right now. The global financial architecture established after World War II is evolving into something new. The dollar's absolute dominance is being questioned. Alternative systems are being built. Power is redistributing. And you have a choice about how you respond to this reality. You can pretend nothing is changing and hope for the best. You can bury your head in distractions and assume someone else will figure it out. Or you can wake up to what is actually happening and take deliberate steps to protect and grow your wealth regardless of which direction the global economy moves. Let me tell you what I would do if I were starting from zero today, knowing what I know now about how money and economies actually work. First, I would treat my financial education as seriously as any university degree. I would spend at least 1 hour daily studying investing, economics, business, and wealth building, not passively consuming, but actively learning, taking notes, testing concepts, building genuine understanding. Second, I would ruthlessly eliminate all high-interest debt. Credit cards charging 15 or 20% interest are financial anchors that make building wealth nearly impossible. Every pound paid in interest is a pound that cannot compound in your favor. Debt can be a powerful tool when used strategically to acquire appreciating assets, but consumer debt for depreciating purchases is pure financial poison. Third, I would build multiple income streams as quickly as possible. Relying on a single employer for all income is extraordinarily risky in an economy where jobs can disappear overnight, industries can be disrupted without warning, and loyalty is rarely rewarded. A side business, freelance skills, investment income, rental property, digital products, anything that creates cash flow independent of your primary employment. Fourth, I would invest consistently in assets that have historically preserved wealth across different economic environments. A diversified portfolio of stocks in productive companies, real estate in locations with strong fundamentals, precious metals as insurance against currency debasement, perhaps even alternative assets like Bitcoin for those willing to accept higher volatility in exchange for potential asymmetric returns. But here is what matters more than any specific investment: understanding why you own what you own, knowing what economic scenarios would cause each asset to perform well or poorly, having a framework for making decisions rather than just following tips or trends. This depth of understanding is what separates investors from gamblers. When China and Japan restructure their reserve holdings, they do so based on comprehensive analysis of geopolitical trends, economic fundamentals, and strategic positioning. They have teams of experts examining every angle. You might not have those resources, but you can develop a similar disciplined approach to your own financial decisions, scaled to your situation. Ask yourself hard questions. If inflation continues running hot, which of my assets will maintain purchasing power? If interest rates rise significantly, how does that affect my mortgage, my investments, my overall strategy? If the currency weakens, where is my exposure? What protects me? These are not abstract academic exercises. These are practical questions that determine whether you thrive or struggle over the coming years. One of the most powerful concepts in wealth building is something called asymmetric risk. This means positioning yourself so that potential gains far exceed potential losses. Investing small amounts in your education has asymmetric returns because the upside is unlimited while the downside is capped at what you spent. Starting a side business with minimal capital has asymmetric potential because it might fail and cost you relatively little, or it might succeed and change your life completely. The wealthy think in terms of asymmetric opportunities constantly. They take calculated risks where the mathematics favor them over time. They do not gamble on long shots, but neither do they play so conservatively that meaningful growth becomes impossible. They find the sweet spot where prudence meets ambition. This is exactly what you need to cultivate in your own financial life. Not recklessness, not paralyzing caution, but intelligent risk-taking based on sound principles and realistic assessment of probabilities. When you understand that every decision involves trade-offs, you stop looking for perfect answers and start making optimal choices given imperfect information. The truth that nobody wants to hear is this: building real wealth requires patience, discipline, and delayed gratification in a world designed to encourage impulsiveness, consumption, and instant pleasure. It requires thinking in decades when everyone around you thinks in days or weeks. It requires going against the grain, ignoring peer pressure, and sometimes appearing strange to people who do not share your financial vision. But the reward for this discipline is something most people never experience: true peace of mind, the knowledge that you are not dependent on any single income source, any single investment, any single system. The confidence that comes from being genuinely prepared for multiple futures, the freedom to make life decisions based on values rather than financial desperation. When you watch nations with trillions in reserves making strategic shifts, do not see it as some distant event that does not concern you. See it as a mirror reflecting principles that apply to every level of wealth: diversification, strategic positioning, protection against scenarios where trust erodes, building resilience into your financial structure. Your wealth, regardless of current size, deserves the same thoughtful stewardship that nations apply to their reserves. Every pound you earn represents hours of your life converted into economic value. Treating that casually, managing it carelessly, or allowing it to erode through inflation and poor decisions is essentially wasting the precious time you can never recover. The most valuable asset you possess is not money, it is time. And how you deploy that time, whether you invest it in learning and building or waste it in distraction and consumption, will determine everything about your financial future. This moment right now, reading these words, thinking about these concepts, is an investment that costs you nothing but attention, yet could be worth more than any stock or property you might ever purchase, because what you understand, truly understand at a deep level, cannot be taken from you. Markets crash, currencies fluctuate, governments change policies, but knowledge, wisdom, and the ability to think clearly about money remain yours forever. Let me share something profound that changed my entire relationship with wealth. Money is not actually about money. It is about options. Every pound you save, every investment you make, every income stream you build is really about purchasing future choices. The choice to leave a job that drains your soul. The choice to help a family member in crisis. The choice to pursue a passion project that might not be profitable. The choice to say no to things that do not serve you and yes to things that do. Most people never acquire these choices. They spend their entire working lives at the mercy of circumstances, one missed paycheck away from disaster. Unable to take risks because they cannot afford the potential downside. Trapped in situations they hate because they need the money. This is not living, this is surviving, and you were meant for more than mere survival. The global financial shifts we are witnessing, with major nations repositioning their capital and reducing dependence on traditional safe havens, is teaching us something essential. Security does not come from holding on to what has always worked. Security comes from being adaptable, diversified, and positioned to thrive across multiple scenarios. Think about the British economy over the past century, from global empire to European member to independent nation again, from manufacturing powerhouse to service economy, from fixed exchange rates to floating currency. Those who rigidly clung to old models suffered. Those who adapted and repositioned themselves prospered. The same pattern repeats at every scale, from nations to individuals. Your career, your skills, your investments all need to be viewed through this lens of adaptability. Are you developing capabilities that will remain valuable as the world changes? Are you building financial positions that work in multiple economic environments? Are you creating a life structure flexible enough to pivot when necessary? The single biggest financial mistake people make is assuming tomorrow will look like today. They project current conditions indefinitely into the future. They believe their job will always exist, their pension will be there, their currency will hold value, property will always appreciate, the government will keep its promises. But history teaches us that permanence is an illusion. Everything changes. The only question is whether you are prepared for that change. When I look at someone truly financially secure, I do not see how much money they have. I see how they think about money. I see whether they understand cause and effect, whether they can delay gratification, whether they invest in learning and growth, whether they build systems or just chase outcomes, whether they think strategically or just react emotionally to market movements. You can give someone £1,000,000, and if they lack the proper mindset, they will be broke within years. This happens constantly to lottery winners and professional athletes. Massive windfalls squandered because the internal operating system, the mental framework for managing wealth, was never developed. Conversely, you can strip someone with the right mindset of everything, and they will rebuild because they possess something far more valuable than money. They possess the understanding of how to create it. That understanding begins with recognizing that you are not a victim of economic forces. You are a participant in an economic system, and you have far more agency than you probably believe. Every day presents choices, small choices that seem insignificant but compound massively over time. Do you spend this hour learning something valuable or scrolling mindlessly? Do you invest this surplus or spend it on something fleeting? Do you have a difficult conversation about money with your partner or avoid it? Do you track your spending or remain willfully ignorant? These micro decisions, repeated thousands of times, create your financial destiny. Not the government, not the economy, not luck or privilege or circumstances. Your choices consistently applied, following sound principles over sufficient time. Now, here is where most financial advice fails you. It gives you tactics without strategy. It tells you what to do without explaining why. It offers rules without teaching principles. Buy index funds, save 20%, avoid debt. These are fine rules, but without understanding the deeper why, they are just things you are supposed to do. And when times get tough or temptation strikes, you will abandon them. But when you understand that index funds give you diversified ownership of productive businesses that compound value over decades, that saving 20% creates the capital necessary to capture opportunities that high interest debt mathematically destroys your ability to build wealth, then these are not just rules. They are logical conclusions you have reached yourself, and you will stick to them because they make sense at a fundamental level. This is why watching China and Japan reduce U.S. Treasury holdings is so instructive. They are not acting on emotion or panic. They are responding to changed fundamentals with strategic reallocation, the same discipline you need in your own financial life. When something fundamental changes in your situation, your industry, your investments, you assess objectively and adjust accordingly. No denial, no wishful thinking, just clear-eyed analysis and appropriate action. The path to financial freedom is not complicated, but it is difficult. Difficult because it requires you to go against human nature, to save when you want to spend, to invest when markets feel scary, to learn when you would rather be entertained, to plan for decades when you can barely think past next week, to be disciplined when everyone around you is indulgent. But here is the beautiful paradox. That difficulty, that friction, is precisely what makes it valuable. If building wealth were easy, everyone would do it, and it would cease to provide advantage. The fact that it requires discipline, education, patience, and strategic thinking is why it works. It is a filter. Those willing to pay the price of knowledge and discipline receive the rewards. Those unwilling do not. Where you are right now financially is the sum of every decision you have made up to this point, every purchase, every career choice, every investment or lack thereof, every hour spent learning or wasted. That might be uncomfortable to acknowledge, but it is also empowering. Because if your decisions created your current situation, then different decisions can create a different future. You are not doomed to repeat the past. You can change direction today, this moment. Not next month when things settle down. Not next year when you earn more. Now, start tracking your spending today. Read one chapter of a finance book today. Set up an investment account today. Have that difficult money conversation today. Small action, immediate, builds momentum that transforms into massive change over time. The world is changing whether you participate consciously or not. Major economies are repositioning. Currencies are evolving. Technology is disrupting industries. The question is not whether change will happen. The question is whether you will be among those who see it coming and prepare, or among those who wake up one day wondering what happened to their financial security.